pay taxes, and then the government spends money. So when the government spends less than what they bring in, no problem. Their tax dollars cover it, and then they have a surplus in case one year they overspend.
Yeah.
But that's not what happens here. We spend more money than what we bring in. So that's why we have this national debt of $30 trillion, this national deficit. And so how do you cover that? Well, if you spend more money than what you bring in, you can do a few things. You can raise taxes, which is going to make people angry if your taxes go up. And so you can't always do that. Second is you can go out and you can borrow money. You can go and raise debt. So that's what the government does. They go borrow money from countries like China and Japan. But there's going to be a limit to how much money you can borrow. So if you can't borrow enough money from different countries, then what's left? Well, then you can issue something called a treasury bond, which is where now anybody, people like you and me, anybody listening to this can go and lend money to the United States government. But if the government is running a big deficit, meaning let's just say they need to raise $4 trillion, where are they going to get this money? Well, if they can't get that money from regular people, then they're going to call up the Fed and they're going to say, hey, Fed, we want to issue $3 trillion of treasury bonds. No one's going to buy it. Can you help us out? Now remember, the Fed doesn't have cash piles sitting there, so what do? They print $3 trillion, give it to the government. This money's created out of thin air. Now the government has this $3 trillion. Inflation just happened, and then the government is able to now spend this money without any sort of taxation. However, you still pay the price. The most expensive kind of money that there is free money. Because now when the government gets this money for free out of thin air, everybody pays the price. And the person who pays the price disproportionately are the poor and the financially uneducated, because now you have to pay for inflation. Your wages don't stretch as far. Your savings don't go as far. And now your cost of living is significantly higher. So you're becoming poorer each and every day. Inflation hurts the poor. And the reason I'm not even talking about the middle class is because inflation is the reason why the middle class is getting wiped out.
It's turning into more poor.
It's turning more either poor or the wealthy, because if you understand what's going on here, you're going to change the way that you use your money, and it creates this divide. So more and more inflation creates a bigger wealth gap. And that's what we're seeing happen now. Some people during the pandemic became insanely wealthy.
Yes.
You know, they talk about how the richest Americans had gained billions and billions of dollars worth of wealth. Well, the poorest Americans saw no change.
Yeah.
And so when the cost of living is going up so significantly and you don't understand this, you're being screwed over by the system and you don't even see it happen.
So here's a dose of morning optimism. This comes via a lot of data crunching by a friend of the show, Keith Lerner, over at Truist. Two stats. First, he's noting the S&P 500 has been higher 3 years later in 8 out of 9 cases in which the index has fallen 20% or more from an all-time high going back to 1957. He also notes stocks have sharply regained ground a year after falling 20% or more from a high. So a year after, that increase has been about 15% 7 times. The bottom line is here, and to your point, Julie, yes, and this also happens to be my take, over time, and Miles Other will like this one very much, stocks do tend to go higher, and that is me being happy sauce with my Ray-Bans on. You know, over time, these extremes that we live in, like right now, high periods of inflation, rising interest rates, over time these things even out or just flatten out and ultimately serve as a once those things do even out, serve as a decent backdrop for stock prices over time.
Contrary to popular belief, bull markets do not last forever. Now, what we have seen in the past, when markets do reach that 20% decline, what usually follows is a total 30% decline, and it can take up to 2 years on average for markets to actually get back to their original values and start moving higher. Now, that's the bad news. The good news is that bear markets also do come to a close, and there are things that you can do to protect yourselves during a bear market decline, and in fact, even make some money while it's happening. Now, the most important thing, lesson number 1, is do not panic. That's the worst thing that you can do, is chase a market lower. You're going to lock in losses and you're going to regret it later.
Look at the last 72 years. This is from 1950 to where we are today. There have been altogether 11 bear markets, which are marked out in red. As you can see, 1956, 1962, 1966, 1968, 73, and so on and so forth. So 11 bear markets in 72 years, that gives us an average of one bear market every 6.5 years. And of course, it doesn't appear exactly every 6 years. In certain periods, they appear more often. Certain periods, they don't appear for a number of years. In fact, the last bear market we had was in 2020, just 2 years ago. And now we're in another bear market, right? So it's kind of like, coming all at once right now. But over the long run, bear markets are not that common. If you take a look at the bear markets, they could be very short bear markets that decline kind of like about 20% or 30%. You got major bear markets during major recessions. Like, of course, most recently was the subprime mortgage crisis, where the markets dropped 57%, and the dot-com bust was like 20 years ago. It dropped like 50%. But if you average all the bear markets, the average decline of all the bear markets is about 35%. So currently the S&P 500 is down 22%. The Nasdaq is down 33%. So people would say, wow, we could go down a lot more. So intuitively and emotionally, a lot of people feel that, hey, shouldn't I get out now before it drops another 10%? And maybe I could buy it back at a lower price. Especially looking back at the two major crashes, the dot-com crash and the great financial crisis, it would have made sense to get out and get back in at much lower prices. For example, if you take a look at the dot-com crash, you can see that it fell, the S&P fell 50% from peak to the bottom, right? So the moment people realize that, okay, it's a bear market, we close below 20%, get out, right? So avoid the other 30% drop, and I could get back in at a much lower price. Made sense if you look at it this way. Same thing with the subprime mortgage crisis, where the S&P fell from the peak to the trough 57%. Again, if you look back at that time, you would say, hey, it would have been good to get out at 20%, and I could get back in a lot cheaper. And that's why research has shown time and again that time in the markets is more important than timing the markets. Because if you time the markets and you get it wrong, and it's really easy to get it wrong because it's almost impossible to predict for certain where's the bottom and when it's going to reverse, right? That in the long run, by holding good companies or holding the index, you're going to be much better off than trying to jump in and out, which most of the time will end up worse for most people. I'm sure you've seen this research before, but I'm going to reinforce it once again. So what would have happened to a $10,000 investment in the S&P 500 if you just missed 5 days out of 40-year investment? So from 1980, if you invested into the markets to 2020, that's 40 years, okay? Now, over that 40 years is a total of, let's see, 10,400 weekdays or trading days. And you can see that if you were fully invested in those 40 years, your 10 grand would have grown to about $952,000, about $1 million, right? But out of those 40 years, if you happen to miss 5 of the best days, of the best gaining days, at the end of the period, you would have only $590,000. In other words, you would have 38% less returns than if you just stayed invested. And if you miss the best 10 days out of those 40 years, you would end up with only $425,000 versus $952,000. In other words, you're down 56% less returns. If you miss the best 30 days, you're down 84% from just holding it, right? If you miss the best 50 days, you're down 93%. You might as well have just held cash. So what's the bottom line? The bottom line is that if you think that you can time the market well and get in and get out and beat just holding it, you're betting that you can get in and out without missing just 5 of those days out of 10,400 days. Good luck to that, right? So the fact is this, the majority of the best stock market days where the market had the biggest gains have come in the midst of bear markets. In fact, of the top 10 best gaining days, 6 of those days occurred during the 2000 tech bubble bust and during the 2008 financial crisis. If you take a look at the greatest investors of all time, whether it's Peter Lynch or Charlie Munger or Warren Buffett, none of them got out during bear markets. None of them, not a single one of them. What did they do during bear markets? They held on and they continued buying good companies at undervalued prices, averaging down their positions. And that's what made them the richest people in the world. And like what Peter Lynch said many times, he said far more money has been lost by investors preparing for corrections or trying to anticipate corrections than lost in corrections themselves. And remember, if you're holding good companies and the price goes down, even if it drops 20, 30, 40% below your purchase price, you have not lost anything. You have not lost shit. If you don't sell, you don't lose, right? Provided they are good companies, because good companies, you know that the price will always bounce back eventually. Whether it's 3 months from now, 6 months from now, 2 years from now, they will go back eventually. So if you're not forced to sell and you don't sell, it ain't a loss. It's only a loss if you sell. And there's no reason to sell unless you're forced to, right? And no one's forcing you to sell. Just hold on.
Value. Let's talk about Warren Buffett. Back in 2009, when everybody else was panicking, Buffett made a big investment in the Burlington Northern Santa Fe Railroad.
And I just basically believe this country, will prosper, and you'll have more people moving more goods 10 and 20 and 30 years from now, and the rail should benefit. But it's a bet on the country, basically.
He believed in America back then, and he also believed that the bear market was going to end, and when it did end, there was going to be a bounce back and an opportunity to make money. That bet played out into one of the best bets of Warren Buffett's career. He has made a ton of money on that over the past decade. Buffett's philosophy can be summed up in just looking for value during bad times and trusting that things are going to turn back around again. Remember what Buffett says: be greedy when others are fearful, fearful when others are greedy. Think safe havens during these times. Short-term bonds, commodities like gold and silver, those are all traditional places where investors will put their money for safety during times of turmoil in the financial markets. If you are going to dabble in stocks, keep a few things in mind. High dividend stocks are an excellent place to put money. Why? Because you're getting paid to hold them. Also, preferred shares along the same lines. And if something does happen with the company, you get paid. In a bear market, people are tightening their belts. So think about where they're going. They're going to discount stores. They're going to Walmart. They're going to Dollar General. Back during the crisis, while the rest of the market was falling apart, Walmart held its value. Why? That's where people were shopping during that downtime, and investors were rewarded for it. Real estate also can be a solid investment during these times. Yes, prices can go down, but they've shown to be less volatile over time. Also, it's nice to know that even if it's not appreciating in value, you can actually live there. And remember, it's not just a U.S. stock market, it's a global stock market. And over the past couple of years, global stocks have gotten beaten up fairly badly. So that's going to present you with an opportunity to find bargains there.
Money to work no matter what. And so one of the easiest things, you can create your own, is to follow something like a 75, 15, 10 plan, which means that for every dollar you earn from now on, 75 cents is the maximum you can spend, 15 cents is the minimum you're investing, and 10 cents is the minimum that you're saving. Now the savings is, you want to build somewhere between 3 and 12 months worth of savings if you want to have that protection. 3 months if you don't have a lot of liability, a lot of responsibilities, you don't have all that going on, and you have a high risk tolerance. 12 months if you want to play it safe. You figure out what's right for you. After you filled your savings, you fill up the savings. You don't want to put any more money into it because now you're just being eaten away by inflation.
Yes.
Right? The savings is not there to make you wealthy. It's there just to protect you against an emergency. Then what you do is you take the money, put it into your investments. And now you just keep investing money. Now what happens is as you grow your income, you don't change this ratio. So if you go from $40,000 a year to $400,000 a year, you keep the same ratio and you're still investing first. And then you keep saving your money, and then you know how much you can spend. Because now what you're doing, which is what wealthy people do, is you invest before you spend. The way that the finances look for the majority of people is you make money, you pay taxes, you spend your money, and then you wonder where your money went. Well, wealthy people do, right? Wealthy people are, you make money.
Especially in California.
Yeah, it's $7 gas and high taxes. But what wealthy people are doing is you make money, and then depending on how you make it, either you pay taxes first or after, ideally after, because there are ways to do that legally. but you make money and then you want to invest as much as possible and then you spend whatever's left.